Well, hello, happy Wednesday to you. It is great to be here with you. You're joining me on the replay. Happy replay as well. I'm live here and I'm excited to welcome you to today's live level up conversation.
Welcome to Level Up with Winnie Sun. Market updates. Award-winning financial pro. Get ready. I present to you Level Up with Winnie Sun.
Hello, and thank you so much for joining me. I'm Winnie Sun, your host, Forbes contributor, CNBC council member, and award-winning financial pro, here to keep you on top of relevant trending business news. But of course, you know what makes this show special, aside from us coming almost every day to you live, is that I'm also going to be monitoring your feedback. So if you're live joining me today, let me know where you're joining me from, what city, and how you're feeling today. It's such a great day to be here with you. It's been a really busy day. Earlier today, I started off with Good Day LA talking about, of course, you guessed it, interest rates, the Fed, and then I just finished, literally just got off at CNBC's Financial Advisor Summit that they just hosted, and that was such a great event. They always do such a great event, and so I wanted to come here and talk about that because I know, as all eyes, of course, have been on the stock market, on the Fed. And of course, welcome back to Level Up because there's been a lot of things that we need to talk about. And I should say in the middle of today, we also did a tweet chat. It's one of those busy days. But before we jump to the news here, let's talk about how the market closed. Now, the Dow closed up 303 points. The Nasdaq also up 270 points. And the S&P also up 54 points. So positive across the board. Now, for those of you who are watching Monday and Tuesday's market and days of last week as well, you're probably a little nervous, right? We've been having some very difficult days, wondering what the Fed announcement today and how that would impact the stock market. Well, interesting enough, today, the Fed did, release their rate increase of 75 basis points, which for those of you who don't know what a basis points is, it's basically 0.75%. That's what 75 basis points equals. Now, this is the largest increase since 1994. And this was not unexpected. In fact, if you've been watching the financial news like I have all week, you've been hearing about 75 basis points or 0.75% increase today for actually a few days now. So definitely not unexpected. The question, though, does lie on whether or not this will produce the need in tapering down inflation that we need. Will this work? That's the big question. And in fact, investors seem to really feel that that was the case. In fact, because of this, you saw the market certainly come back right after the Fed announcement. The market started to move up. We saw that across the board. And so we're ending up on a pretty positive day. Of course, if you look at some of the previous days, you might be discounting what this move means. But I still want to make sure that that was on your radar. This is a big deal. Now, the other things that the Fed talked about today is that they expect further rate increases. Okay. In fact, next month, they're talking about another 0.75% or 75 basis points. In fact, they're saying by the end of the year, interest rates could go above 3.4%. That's what that translates to is probably another 1.75% between now and the end of the year. So what does that mean, right? How quickly will this start to trickle in now that the Fed has increased interest rates? Does that mean that when you go to fill up your gas tank, right, or you go to buy chicken or romaine lettuce, or when you're at the grocery store and you're buying milk, does that mean prices are going to get lower anytime sooner? Well, that's something we like to know because ideally that would be the case. Things would start to calm down. Now, does that mean that costs will come down considerably? Unfortunately, I don't think so. Probably not. These things definitely take time to trickle through. In fact, interest rates affect the economy by influencing stocks, bond interest rate prices, consumer and business spending, inflation, of course, and we're also pushing it up against recessions here as well. It's important to understand that typically you're looking at about a 12-month lag between increasing interest rates and for them to actually have much of an impact on inflation. So it's going to take a little bit of time. We're hoping, of course, sooner rather than later. Now, one area, though, that will impact you if you have this is debt. If you have debt, your debt's about to get a lot more expensive. That is mainly variable debt. I'm not talking about fixed debt, right? So your payments on variable interest rate debt will definitely equal higher payments too. Now, with mortgages, this could be some good news. Now, if you already have your mortgage, you have a fixed mortgage, maybe 15, 20, or a 30-year fix, not something that you probably need to worry too much about. You probably refinanced in the last couple of years, or maybe you bought recently and the rate was still, you locked in at a very good rate. But what this does mean is for those of you who are looking to purchase a new home, or looking to refinance, it might not be as advantageous for you. In fact, the 30-year mortgage rate just surged to 6.28%. Now, to give you an idea of how high 6.28% is, just last week it was at 5.5%. So interest rates have definitely started to come up higher. Now, if you're talking about buying a new car, borrowing rates are also going to be higher there because the Fed increased borrowing rates, right? Credit card debt. This is an area I really want you to pay attention to. If you have credit card debt, those rates and payments will likely increase. So I would like you to jump on the phone, call your credit card companies and see if there's something that you can do, start a payment plan, find a way where you can come together and maybe lock in a lower rate before it gets even higher. Another area I think it's important to note is variable student loans. A lot of students actually have variable student loans, and this is going to more likely also increase rates, and the payments will likely also increase. Now, if you have a home equity line of credit or adjustable rate mortgage, another area that you really want to pay attention to too, because again, that's an adjustable rate and the rates are going up, and therefore your costs are going to go up as well. So that's really going to impact your cash flow. So you want to pay attention to that. But before I jump into more, I just want to jump in and say hello. It is great to see Vicky Garvey at Facebook Live. It's great to see you. I see Sadiq joining us from LinkedIn Live. Always a treat to have you here. Robin Stevens, I know, amazing. I know it's been a very busy day. Very, very grateful to be busy. And Joshua, yeah, happy Wednesday to all of you. And anybody else, I see a lot of you joining us today. Definitely let us know where you're joining us from and how your day's going. Mine's been really busy, but it makes sense, right? The Fed had an announcement. I'm in the financial industry here. It's very, very busy here. Now, in terms of investing, now, if you are invested in your 401k or you have an IRA or a Roth IRA, and you have stock and mutual fund holdings, you definitely can expect the market continue to be volatile. Now, obviously, volatility doesn't mean only going down, because there's days like this, right? Days like this where you see positivity on Dow, NASDAQ, and S&P. But it should be known that there's usually when interest rates go up, that does normally does mean that there is some increased volatility on the downside as well. So in the near term, you should expect that things will continue to move up and down, and probably the dips will continue to come as well. Okay. So what do we know? What do you want to know? These are a lot of things that you should know. When interest rates are rising, both businesses and consumers typically cut back on spending. So let me ask you this. Inflation prices have been already sky high. Like the amount that you spend on groceries, really high, right? The amount that you pay for gas to fill up your tank has been really high for those of you who still use gasoline, and probably cost to heat your house or cool your house. You've seen that cost increase as well. And here in California, water prices, I think, are just going to get even higher too. So a lot of our monthly budget expenses are just going to get higher. Now, this causes concerns, right? Because inflation prices can't just continue to get higher. How people are going to maintain? But when you increase interest rates, that also means that businesses and consumers, many of us, will actually start to cut back on our spending as well. So typically what happens when this occurs is that it will cause earnings at companies to start to fall, right? Because you're not spending as much. And therefore, this can also trickle down to stock prices dropping as well. Really important that you remember that and pay attention to that. So if we see the stock market start to pull back, we see some of that volatility creep up even more so in the stock market, know that that's pretty much expected. And that's what we've seen in the past as well. But I still want to talk to you about some more. In the short term, should we do anything? Should we just like hold off and wait for the best? Here's what I always say. It's really important to be paying attention to your investment time horizon right now. Now, your investment time horizon, this is mean, and I want to make sure that I share this word with you. Like the investment time horizon, I didn't say your age, I said investment time horizon. I'll give you an example. So recently I spoke to somebody and they're in their 20s, right? And they said, well, and I asked them, so what's your investment time horizon? How long can you hold this investment? And they said, well, I'm only in my 20s, right? And so I want to go all aggressive. And I said, okay, this is in their retirement account, their 401k. And I said, okay, so you plan to stay at this company for a really long time, right? Like 10 years, maybe 20 years. And I said, oh, no. I think I'll probably leave in about 6 months. And I said, well, see, that's different because your age, yes, you're in your 20s, but your investment time horizon for the money that's in your 401k is now 6 months. So you can't really invest it really aggressively without recognizing that if you do that, you have a higher probability of loss in the short term, right? Because you're taking on a considerably larger amount of risk in a very short amount of time. Super important. Investment time horizon is not the same as age, not always. Sometimes it is, but let's be honest, many of us don't envision working at the same company for 10, 20, 30 years, like maybe our parents did and maybe our grandparents did. So really important to pay attention to that. Now, if you're planning to retire the next year, this is an opportunity where you should be talking to a financial advisor to see if you're still on track. You want to see if your projected income, if there's a shortfall with income. Most people don't have excess income. If you have that problem, it's really probably not such a problem, but still, obviously, something you can talk to your advisor about. But if there's a shortfall of income, we need to talk about that. Do you need to work more years to bring in a little bit more money to fill in those gaps, or maybe a lot of money to fill in those gaps? And can you cut your monthly budget expenses? Because most importantly, it's like each of us is sort of a financial balance sheet. We have a certain amount of income, we have a certain amount of spend. If our spend is higher than our income, and it's not going to stay solvent and be enough for when we get older and when we retire, then we need to sort of make those changes now. So there's a lot of things to be considering. But one thing that I shared earlier this morning on Good Day LA that I'll share with you as well. I've been doing some research, and what I've seen is for bear markets starting from World War II till now, like not all of them, but many of them, like on average, right? If you invested new investments, new cash into the S&P 500, for example, right, which is an index, right, during that time, and you consistently added during the bear market at a low point in the financial markets, on average, 12 months after that, well, the return is over 20%, believe it or not. So what that means is if your time horizon is long, right, and you make sure that you stay diversified and you understand the risks and whatnot, right now offers a potential for some good long-term financial moves. So don't just go out there and just go crazy and go shopping. That's not what I'm suggesting. What I am suggesting is that you have that discussion. You reach out, you let us figure this out together, put together a plan, work on your retirement. Make sure you know how much you need for your future financial goals. Find out what that yield bogey is and proactively figure out a way to automatically save consistently if you can, right? This is, of course, not a formula if you have tremendous amounts of credit card debt, right? Or anything like that. Investing when you have debt is a lot like jumping in a swimming pool with a broken arm. You're not going to get that far. So make sure to get your debt taken care of. Make sure you have no debt, and then pay off all those credit card debts, high yielding debt, and make sure, especially right now that interest rates are going, make sure you get that done, and then really focus on building towards that future, because there are opportunities right now that I don't want you to miss. But lots of news, lots of things that we're going to be talking about. Again, so many things that we are seeing this week. I'm going to continue to update you on more information. Now, tomorrow on the show, I definitely want to make sure that you know, and definitely want to invite you, because tomorrow we have a really great show. We have a guest coming on, And let me just say, I've done some research on his backstory. He is someone that you're really going to enjoy meeting. Or just a really great human, really great guy. From what I've been doing research, I think you're going to really like him. But we're going to have him on the show tomorrow, so we'll have a really informative guest once again. So thank you so much, my friends, for watching and supporting the program, and thank you so much for always being there for me. If you don't mind, take a moment to share this show with someone that you care about, someone that could use this information to their benefit. As a reminder, you can find full episodes of Level Up on NASDAQ, the KBCW, Amazon Fire, Roku, and of course, a social media platform that you're watching me here on. And I'm excited, of course, to announce also that my brand new podcast is now available just about anywhere you listen to podcasts. And the name of the show is Yes Factor with Winnie Sutton. So please tune in and be well. And I can't wait to see you again tomorrow. Take care now.